Hello, very good afternoon to all, and welcome to today's Daily Dose of Market Insights. I'm Kelvin here. Very good afternoon. Today will be Tuesday, the 11th of February 2025. So before we start our gist of today's Daily Dose, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, let's have a quick recap what has taken shape yesterday, early this morning in terms of the intraday technical movement, or i.e. the intraday performance of the various broad-based cross-asset classes, as well as any key data or events that we should be aware of. So yesterday, what we could see over here is that in the overnight US session is rather positive again. So what we could see over here is that across the board, we have positive closes on the major 4 major US stock indices. The SPX is up 0.67%, the Nasdaq is up 1.24%, the Dow Jones underperformed together with the Russell 2000, both up by marginally by 0.38%, and the Russell 2000 is up by 0.36%. So what you could see over here is that very interesting over here is market is still the stock market, the US stock market is still strangling off this we call it Trump's new tariffs plan that could potentially inflict higher inflationary pressure into the global economy, and the participants in the stock market still view this as Trump tariffs plan is more like a trade rather than he will follow through. That means, i.e., he just announced a very big steep tariffs against whatever US targeted trading partners. Then thereafter, he will actually hold back these trade tariffs and even potentially kick the can down the road as some negotiation process take hold. So the US stock market participants seems to be calling that as a bluff. But however, the FX market doesn't view it this way. So if you look at the FX market, we start to see dollar strengthening in this looming new tariffs plan. Later I'll touch more about that on the news flow and cover, but let me cover the performance of the FX market first. So the dollar continues to strengthen, kind of a different kind of behavior versus the stock market, US stock market participants behavior, because the FX market participants seems to be much more affair to Trump's so-called trade tariffs is likely to actually ignite a higher inflationary pressure in the US economy, and that could potentially lead to a less dovish Fed in 2025, and potentially we'll start to see US fixed income interest rate trading at a higher premium against the rest of the world, which is supporting this US dollar strength yesterday. Okay, so we start to see contrasting market behavior between market participants in the US stock market, which is calling Trump trade tariffs like a bluff. However, for the FX market participants, they view it as a reality that could actually stoke higher inflationary pressure. So who is right? Over here, honestly speaking, I can't tell who is right, but as a short-term technical analysis, we call it later I'll share with you. We got to take things one step at a time in terms of the shorter-term technical analysis view, and from there, we will see how the price develop thereafter on the intraday basis, which I'll touch more about that thereafter when I cover the intraday technical outlook segment. So net overall impact, the 5-day rolling performance of the US dollar as of now, we are speaking 11th of February, start to see a strengthening across the board. But what you can see, there's a big gap in between the dollar yen and the other dollar major cross pair, major pair, like the dollar against the euro, the dollar against the Swiss, the dollar against Sing, the dollar against CAD, or the dollar showing signs of intraday dollar strengthening. Then how come the dollar yen remains lackluster? So like I want to stress over here is that the dollar yen is also could be used as a safe haven currency, means the yen could be used as a safe haven currency as well as a hedge by speculators. That means, i.e., if we start to see a kind of a risk pronounced, or I wouldn't say very pronounced, much more glaring risk of price action in the major US stock indices, the yen could benefit from it. But that means, if the yen benefit from it, the dollar strength should be less pronounced in the yen. So as what we are seeing right now, based on the 5-day rolling performance. And also, do not forget the monetary policy path between BOJ and the Fed also stands to diverge as well. So yes, even though the Fed is less dovish this year, they haven't indicated any signs or guidance that they will relook to their hiking cycle back again in the US economy. Whereas for Bank of Japan, very clearly, key Bank of Japan officials have stressed that if several key Japanese economic indicator like wage growth, which is been rather firm in the last month or so, stable inflation above 2%, which also has been taking shape as well. So these two economic check boxes has been ticked. That actually increased the odds that Bank of Japan will continue its normalization interest rate hike cycle this year. So far, they have only increased one interest rate hike this year. This is the third time since 2024 to bring the bank policy short-term rate to 0.5%, and market is now looking for additional two more hikes in Japan by BOJ of 25 basis point each to bring the policy short-term rate to 1% before 2025 ends. So that also kind of support the lackluster dollar movement against the yen, as we are seeing in this 5-day rolling performance chart over here. So later I'll share with you what is the short-term intraday technical outlook on the dollar yen. Still recall that in the last 2 days since Friday, we are looking for a counter trend rebound within a medium-term downtrend. And yesterday's counter trend rebound has also failed again close to the 200-day moving average. Okay, we'll touch more about that when I cover the dollar yen segment. And what's interesting over here is that despite this dollar strength that is firming, we start to see gold price continues to actually shape higher high. So gold yesterday hit the high part over here, almost printed a fresh all-time high in today's Asia session at the 2,942 level, which is also our resistance that we highlighted yesterday at 2,940/2,945. So the key thing about gold is why gold is rallying so much despite the fact that dollar is still firming is because of stagflationary pardon me. It's because of stagflationary risk that may be on the looming horizon. So what I mean by stagflationary risk? That means inflation getting elevated, Trump trade tariffs trigger a global international trade disruption that could lead to slower economic growth prospects in 2025. So that's why gold is actually used as a hedge and being bidden up at this point in time. So what's interesting over here is that the US stock market is actually does not want to actually move in line with the narrative that is being priced in the FX market and as well as in the gold commodities market, and they're going to ignore that the US seems to be going to be the best market against the rest of the world, given the fact that also the possibility of Trump steep tax cuts that may come in the later part of 2025 that could potentially improve the bottom line of US corporation, indirectly increase earnings growth, and that could potentially offset the negative impact of trade tariffs there. But we got to see which market is right going forward. So at this time, we just got to take note of various key levels I'm going to share with you and some of the intermarket dynamics that is taking shape. All right. So now the next key flow yesterday, there's not much economic indicator to take a look at. With the key thing over here is Trump. Trump finally made officially signed the executive order to set a 25% tariffs on both steel and aluminum across the board. That means across all countries over here, and that could actually take impact on 4th of March. All right, 4th of March, and he also warned that the 25% tariff rates on steel and aluminum may go higher down the road. All right, so he's actually now kind of up the ante in his hawkish trade tariff policy, and some of the market participants are calling bluff to say that Trump is just doing a kind of a big cannon approach, giving a very strong hawkish rhetoric, but thereafter down the road he will tend to actually negotiate on some middle ground over here to extract some benefits for the US from US major trading partners. And also yesterday he did mention that we know that Australia itself is also a exporter of metals, resources, we call it base metals over here. He did mention over here is that Australia may be exempted. All right, Trump indicated that he may consider a break for Australia, but that nevertheless also doesn't actually cause the Aussie dollar to rally. In fact, the Aussie dollar continues to inch down lower, despite the fact that Trump did mention yesterday that there could Australia may be exempted from this 25% steel and aluminum tariffs that's going to hit against the rest of the world by US. All right, and because of these trade tariffs over here, what's interesting over here is that we start to see in the Asia session as speaking right now, the US stock market futures, that means i.e. the E-mini futures on the S&P 500 and the E-mini futures on the Nasdaq 100 that is trading almost like a 24 hours basis. I think there's only a 1 hour break between 5 to 6 a.m. Singapore time. Right now, they're actually down by negative 0.2% each, all right, as we are speaking. All right, based on the futures, the S&P E-mini futures and the Nasdaq 100 E-mini futures. All right, so that is the key news flow that has taken shape yesterday, and how does the price action react based on the various cross asset classes that I covered earlier on. So now let me now share with you all a very interesting intermarket dynamics over a medium-term horizon that could actually unfold from a multi-week to multi-month perspective. Is more related to the China stock market against the rest of the world. So let me share with you this particular chart over here. So what I did over here is that this is the ratio chart where I plotted a dollar-dominated ETF, China stocks basket ETF listed on the US stock exchange, which is the iShares China large cap. So this is considered as the large cap A shares in China, but except the fact that the fund manager or the ETF manager construct it in a way that is dominated in USD. That means we are able to take away the foreign exchange, we call it effect on this index over here, on this index ETF, pardon me. And the orange one over here is the Invesco Golden Dragon China ETF. So this consists of what I call the growth stocks. And lastly, the Crane Share CSI China Internet ETF. So this is more considered a China big tech stock, the likes of Baidu and Alibaba and Tencent. And this is a ratio chart. That means these three Chinese stock basket ETF listed in the US exchange divided by the MSCI All Country World ETF listed in the US exchange as well. So it's something like, take away is that China stock basket versus the rest of the world. So this is the ratio. So since hitting a high in February 2021, so that is coming up with about a 52-week high, the China stock market has underperformed against the rest of the world. So that should be, I mean, the story, the narrative is pretty much clear. COVID stringent shutdown, COVID reopening much later than the rest of the world, and together with also China top policymaker rampant clampdown on the private sector of the Chinese economy, targeting the China big tech in the last 3 to 4 years. By what I call it, alleging that they are actually going against certain policy that is not in certain business model that is not in line with China top policy maker for the greater good of China. So that's what happened, okay, in 2021 all the way down to 2022, 2023. But what's interesting over here, since 2024, this line, this ratio line has started to form a major base. That means they can't break lower and start to form a series of similar high, and most recently it starts to form a higher low in middle of January this year. All right, so what it means that this ratio, this tree ratio has starts to decline initially, and now this decline has starts to stabilize, which represent that the prior major underperformance of China's stock market has starts to lessen or be lesser against the rest of the world stock market. And what's interesting is that I also plotted at the bottom the momentum indicator of this tree ratio by using a 20-week rolling momentum. And this 20-week rolling momentum of this tree ratio is now showing positive momentum. Okay, you could see over here, it's now going to the positive territory for the large cap versus the MSCI all country world, the Golden Dragon China ETF against all country world, and as well as the Crane Share CSI China Internet ETF against all country world. Momentum also has started to turn positive. So all these three ratios have started to turn positive momentum. That means, i.e., it start to show signs that China's stock market underperformance has more or less starts to form a base, the major underperformance since February 2021. And from a medium-term perspective, that means talk about multi-week to multi-month, tactically the China stock market may outperform against the rest of the world. Right, so something to actually take note of. Number one, also be supported by cheaper valuation, and another we call it story over here is that in my own opinion, it hasn't been picked up by the most market participants, is that it's more like this geopolitical factor that is at play. Okay, this time around, trade war 2.0 is different in terms of scope and implementation, especially scope with trade war 1.0 that was ignited in 2018. So this time around, US imposed tariffs not only on China. Okay, at the point in time, trade war 1.0 was against China. So right now is trade war with the rest of the world, or put away that trade war with major trading partners of US that has significant trading, significant, we call it trade surplus. Okay, with the US, that means i.e. countries like example could be potentially India, Vietnam, Malaysia, and we have European Union, Canada, China, Mexico. So instead of China getting hit with trade tariffs, the other major trading partners that has significant trade surplus with US highly likely will get hit with trade tariffs as well. And if there is no room for negotiation, and it will lead to kind of a more tick for tat measures, potentially long-term airlines of the US may start to sway into China, sphere of influence, that means signing up FTA agreement with China or whatsoever, and that potentially could lead to more foreign fixed asset formation or investment back into China, which could potentially benefit the Chinese economy in the long term. All right, so this is something potentially could happen. That means it's a negative boomerang effect of US actions, and that could potentially benefit China if this long-term US allies starts to sway into China's sphere of influence. All right, so that could also be potentially building a base for potential China stock market performance against the rest of the world, as we start to see it being showing up in the relative strength chart over here in your screen, which I am showing to you guys right now. All right, so this is the intermarket dynamics more pertaining to the China stock market. All right, so with that, now let me expand my screen. Now we will touch down on our next segment of the daily dose, which is the intraday technical outlook on the various broad-based cross asset classes. All right, so let us start with the FX market. So over here for the FX market, the euro dollar. Okay, still recall that the euro dollar, we flipped to a bearish bias yesterday. So price action, yes, initially it rebounded during the European session, and it can't actually make much headway and starts to trend or inch down lower throughout the US session. So still no change, still using the 1.0360 as my short-term pivotal resistance level, maintain the intraday bearish bias of the euro dollar, a breakdown below the near-term support level at 1.0270 exposes 1.0220/1.019, which is the ascending trend line that is still in place since the low of 13th of January, and as well as the medium term swing low of 13th of January as well. So it's like a zone over here. If 1.027 breaks, okay, potentially there could be an exposure towards this 1.0220/019 support zone. Only an hourly close and a breakout above 1.0360 potentially negates today's intraday bearish bias to see a potential squeeze up to in first step test the next intermediate resistance at 1.0405, which correspond to last Friday non-farm payroll minor swing high that spiked up, exposed non-farm payroll minor swing high, and as well as this minor descending trend line that is in place since 27th of January. Break up above 1.0405 potentially may kickstart another round of minor mean reversion rebound in first step, exposing the next intermediate resistance zone of 1.0440/1.0460. So i.e. in a nutshell, if 1.0360 short-term pivotal resistance is not surpassed to the upside, we will still maintain that potential intraday bearish bias as depicted by the current technical elements that is showing right now. Onward next will be its cousin, the sterling dollar. So the sterling dollar plummeted as expected and broke below the 20-day moving average, and also break below our first support level that we highlighted yesterday at 1.2375 over here. So with that, this could be a potential pullback resistance level to watch for today at 1.2375. So with the breakdown of this 1.2375, we could tighten our short-term pivotal resistance slightly to yesterday's minor swing high over here at 1.2415 level. Okay, let me put it in writing. Okay, so this one I copy paste. Oops, Control Z. Copy paste. Okay, let me put it in writing. 1.2415. Okay, 1.2415 short-term pivotal resistance level. Then this will be the next resistance level to watch. Okay. Okay, so 1.2415. Okay, short-term pivotal resistance level. Still maintain the intraday bearish bias on the sterling dollar. Next support level to watch out for will be at 1.2240 level, which is the minor swing low of 3rd of February. Confluence with the previous congestion area of 17th of January and 21st of January. All right, only a hourly close and a push up above 1.2415 will negate today's intraday bearish bias on the sterling dollar to see a squeeze up to revisit the next intermediate resistance at 1.2460/2490, which correspond to the 50-day moving average, acting as a similar resistance zone as well. Only a breakout above 1.2490 potentially open up scope for a extension of the minor mean reversion rebound scenario coming back into the sterling dollar, potentially exposing the next intermediate resistance zone thereafter at 1.2580/1.2610, which is the minor swing high area of 30th of December and 7th of January this year. So i.e. using a tighten key short-term pivotal resistance for today on the sterling dollar at 1.2415 to maintain its intraday bearish bias based on its current technical elements that's as we are speaking right now. Now, up next will be the Asia Pacific currency against the dollar, starting with the Aussie dollar. So I mentioned, despite the fact that Trump mentioned that the Australia may get exemption from his 25% blanket trade tariffs against all steel and aluminium exports heading into the US, the Aussie dollar still remains lackluster below the 50-day moving average and still trade below our short-term pivotal resistance that we highlighted yesterday at 62.95. So still no change there, using 62.95 to maintain that intraday bearish bias, but first support level to watch will only be at 6240/6255. 6225. Only a breakdown below 6225 potentially may see much more potential weakness on the Aussie dollar to potentially expose the next near term support level at 0.6165 next. However, an hourly close above 62.95 will invalidate today's intraday bearish bias to see a push up to test the medium term pivotal resistance level in the first step at 63.30. All right, so that's for the Aussie dollar. What's up next for the dollar yen? So dollar yen yesterday tries to shape that rebound again. So that rebound actually almost hit the 200-day moving average, which is our resistance zone as well at 52.90/53.25. So given the kind of a lackluster price movement that has taken shape since the earlier push up yesterday during the European session, price action just try to trade sideways again. So for today, given the fact that it's coming rather close towards this resistance zone, so I'll be using this resistance zone over here, 52.90/53.25, which is also the 200-day moving average, to turn into a bearish bias once it come close to this zone over here. So first support level to watch out for today will be the 150.95/70. Only a breakdown below 150.70 with hourly close below it potentially increase the odds of the continuation of this impulsive downward sequence within its short to medium term downtrend phase, as price action now has traded below the 50-day and the 20-day moving average, exposing the next near-term support level at 149.70/30, which is the 1.238 Fibo extension level taken from the ongoing minor downtrend phase that is in place since 10th of January. and also the 14970/30 is also the minor swing low of 5th of December and 9th of December last year. Only a push up and an hourly close above 153.25 short-term pivotal resistance zone upper limit will invalidate today's intraday bearish bias to see the extension of the mean reversion rebound in minor scope to expose the next near-term resistance level at 154.10 next. All right, so i.e. Using 15290/153.25 potential turning point, which is all the 200-day moving average, and that will be as our short-term pivotal resistance zone for today, and we'll flip to a intraday bearish bias on the dollar yen for today. Okay, so that's for the FX market. Now, turning our attention now towards will be the major stock indices, starting with the Hong Kong 33, representing the Hang Seng Index. So still recall that yesterday we flipped to a bearish bias because the rally is coming very close to the upper limit of this minor ascending channel that is in place since 13th of January, and also our resistance level at 21,700, 21,800, which is the minor swing high congestion area of 3rd of October and the 1.236 Fibo extension taken from the low of 13th of January, and couple that the RSI has started to turn lackluster by flashing out bearish divergence yesterday as well at the overbought level. So this representing potential start of a minor corrective decline sequence or a mean reversion decline scenario back towards the lower limit of this minor ascending channel that is still in place since 13th of January 2025 low. So still no change. Indeed, there's a bearish reaction of that 21,710, 21,800 short-term pivotal resistance that we have for yesterday, and this is indeed a resistance level to watch because of the bearish reaction upon a test on it at the start of today's Asia session. So still no change as long as 21,710, 21,800 short-term pivotal resistance on the Hong Kong 33 is not surpassed to the upside. We'll still maintain today's intraday bearish bias for a potential ongoing minor mean reversion decline scenario to play out within this minor uptrend phase that is still intact since 10th of January low. Next near-term support level to watch in the first step will be 20,980/20,830. Below it exposes 20,590. We also correspond to the lower limit of this minor ascending channel. Only a push up and an hourly close above 21,800 will invalidate today's intraday bearish bias to see the continuation of its impulsive up move sequence, exposing the next intermediate resistance level of 22,000/22,050. Above it potentially sees the 1.618 Fibo extension from the low of 13th of January, which is acting as a resistance at 22,470 as well, which is also the minor congestion area of 3rd of October last year and 7th October last year. So that's for the Hong Kong 33 using 21,710/21,800 to still maintain short-term pivotal resistance zone to maintain that intraday bearish bias for that potential minor mean reversion decline scenario to play out. Right, now onward next will be the Japan 225 representing the Nikkei 225. So still no change as it continues to trade kind of a below this sideways range configuration within a complex medium-term sideways range configuration that is in place since late September last year. Right, still no change. So upper limit of that of this sideways range, this minor sideways range that is in place since the low of 3rd of February continues its price action over here. Let me remove this. So that will be 39,310. So as long as 39,310 short-term pivotal resistance is not surpassed, we'll still maintain that intraday bearish bias within this minor sideways range configuration that is in place since the low of 3rd of February. Support level to watch will be at 38,380, the lower limit of this sideways range, / 38,140, which is the minor swing low area of 13th of January and 17th of January. Only an hourly push up above 39,310 short-term pivotal resistance will invalidate today's intraday bearish bias to see a squeeze up towards the upper limit of that medium-term sideways range configuration. In first step, the next resistance level to watch will be 39,710 / 39,830 over here. Right, so that's for the Japan 225. Now onward next will be the European stock index, which is the German 30 or the German DAX. So the German 30 and German DAX continues to rally and hit our first resistance level as we are speaking right now, the 21,960/990. So it hasn't surpassed above it yet. So we do not want to tighten the key short-term pivotal support to be so tight. So we do have a first support level over here, which is yesterday's kind of European session this low here, this minor swing low at 21,800. So as long as the 21,640 short-term pivotal support that we have for yesterday didn't broke down on the downside. We'll still maintain the intraday bearish bias. The next resistance level to watch will be 21,160, which is also the upper limit of this ascending channel that is in place since the low of 20th of November. Only hourly close below 21,640 will invalidate today's intraday bullish bias to kickstart a mean reversion decline scenario in minor scale to expose the next near-term support level at 21,390, which correspond to the rising 20-day moving average. A breakdown below it may see a deeper slide to revisit the swing low of 27th of January and 3rd of February, acting as the next near-term support level at 21,100. So that's for the German 30, still maintaining that intraday bullish bias using the unchanged 21,640, pardon me, short-term pivotal support level. Okay, now back towards the US major stock indices, starting with the US Wall Street 30 representing the Dow Jones Industrial Average. So it's rather lackluster over here. It seems to us that it's being trapped within this symmetrical triangle like configuration in minor scale since the high of 31st of January. So with that, we will flip to a neutrality stance, neutral between the upper limit of this symmetrical triangle and the lower limit of this symmetrical triangle, which is also the 20-day moving average acting as a support level. So neutral between 44,250 and 44,840. Next, only a breakdown below 44,250 with an hourly close below 44,250, then potentially we could kind of trigger off a minor corrective decline sequence in first step, exposing the next near-term support zone at 43,730 slash 43,600 next, which also correspond to the 50-day moving average. Now, next up will be the Nasdaq 100. So the Nasdaq 100 managed to squeeze up yesterday, and that negative reaction came right exactly off the short-term pivotal resistance zone that we have for yesterday as well at 21,840/945. So we still use the 21,840/945 short-term pivotal resistance level to maintain that intraday bearish bias within this sideways range configuration that has started to unfold since the high of 23rd of January for the Nasdaq 100. First near-term support level to watch out for, which is coming close to the 20-day moving average, acting as a support level as well, will be this 21,560. That will be my first support level to watch. 21,560. Okay, only a breakdown below 21,560 today potentially open up scope for a deeper potential slide within this minor range configuration that is in place since the high of 23rd of January to expose the next near-term support level at 21,340 next. However, a breakout above 21,945 short-term pivotal resistance level will invalidate today's intraday bearish bias to see a squeeze up to revisit the current all-time high level at 22,135 that was printed in early middle of 17th of December last year, right over here. Okay, so that's for the Nasdaq 100 and also sum up the intraday technical outlook on the major stock indices. Now, turning our focus now will be gold XAU/USD, which is the commodities market. So for gold XAU/USD, what you could see over here is that very clearly price action hit the resistance level and now shape a pullback over here. So this pullback now is considered as a first support level to watch at 2,900 or 2,910 level. Very interesting over here is that the hourly RSI has just exited from the overbought level. There's no signs of a exhaustion yet or a bullish exhaustion because there's no bearish divergence that's being formed on the hourly RSI. As price action trade high, hourly RSI also shape higher high. So with that, we will have a tighten key short-term pivotal support level for today. As long as any minor pullback didn't surpass below 2,880. So that is my tighten short-term pivotal support on gold XAU/USD for today to maintain that intraday bearish bias on gold as it continues to accelerate since the retest of that former upper limit of that minor ascending channel on 7th of February. So this is considered as a trend acceleration right now. So using a tighten key short-term pivotal support at 2,880. Next resistance level to watch after 2,945 will be 2,990, followed by 3,000 psychological level and as well as a Fibo extension cluster. Only an hourly close and a breakdown below 2,880 next will short-term pivotal support will invalidate today's intraday bullish bias to kickstart a minor mean reversion decline scenario, exposing the next near-term support level at 2,845. A breakdown below 2,845 sees a deeper minor mean reversion decline scenario unfolding. exposing the next near-term support zone of 2008-12, 2007-95, which is the lower limit of this minor ascending channel that is in place since the low of 31st of December, and as well as soon to be the rising 20-day moving average as well, that is coming close to 2008-12/2007-95. So i.e. using a Titan key short-term pivotal support for today, 2880 short-term pivotal support on Gold XAU/USD to maintain the intraday bullish bias. Lastly will be the West Texas crude oil. So West Texas crude oil over here did a kind of a push up and play around with the 50-day moving average, and now coming very close to the upper limit of this minor ascending minor descending channel from the high of 16th of January. And what I could see, the hourly RSI now has started to exit from the overbought zone, as you could see over here. So with that, no change, still using 7270/7320, a bit of excess, maintaining that intraday bearish bias. But we have a first higher support level to watch out for today will be at 7180. All right, 7180. Let me put it in writing. 7180, only a breakdown below 7180, potentially revisit last Friday minus swing low and at 7105. All right, they managed to survive on last Friday. Only a breakdown below 7105 open up scope for much more of a deeper bearish bias, exposing the next near-term support level at 6980, which is the minor swing low area of 27th of December. But however, if price action starts to have an hourly push up and the close above 7320, then today's intraday bearish bias will be invalidated, and we may start to see the start of another choppy rebound scenario unfolding for West Texas crude oil within a very kind of a complex major sideways range configuration. In first step, exposing the next resistance level at 74.15, which is coming close to a 200-day moving average. Above 74.15, potentially revisit 75.75/76.16 next. All right, so that's also sum up the intraday technical outlook on West Texas oil and as well as the other broad-based cross asset classes. So before we go, let's have a quick look at the economic calendar. What are the key things to look out for today? Today will be Tuesday. So for Tuesday, during the European session, we do have a key Bank of England official speaking, Bank of England man speaking at 4:45 p.m. So that could potentially impact the sterling dollar and the sterling crosses rate, and followed by his boss, Bank of England Governor Bentley's speech will be at 8:15 p.m. Then thereafter, the more important will be the boss from US Fed Chair Powell, semi-annual testimony to Congress. So today he will have his testimony to the Senate. To the Senate. Today it's the Senate, one of the committee of the Senate at 11 p.m. Singapore time. So I believe that the Senate members will quiz Powell's view on how does current Trump tariff policy impact the thinking and the guardians of Fed monetary policy decision going forward down the road. So something to actually take note of that could potentially impact almost all cross asset classes if based on his testimony and potentially how he conveyed the message over here. So that will be at 11 p.m. Singapore time. And thereafter, during the later part of the session, way early during Singapore time at 4:30 a.m., we have two Federal Reserve officials speaking, Fed Bowman and Fed Williams over here. So yep, that sum up today's daily dose of market insights. I wish you all a great day ahead. This is Kelvin here signing off, and we shall speak again tomorrow. Thank you.